Good afternoon, and thank you all for joining us here at Athene today. We're excited to have you on board and wanted to present today the Indexed Annuities from Origins to Alts. This is going to be recorded, so you are going to get the slides at the conclusion of this webinar. We will also post it to the Athene Connect webinar. If you go onto Athene.com, in the lower left-hand corner, you can see all of our past webinars are available out there. We are also hosting another webinar this afternoon to discuss one of our alternative indexing options. We've partnered with HSBC and we have the new Apex option available, and so that is going to be hosted today at 2 p.m. Central Time. If you are interested, again, please visit Athene Connect. You can certainly still register for that and get in on that opportunity. As with any of our webinars, anytime you register for them, we will send you a recording. So even if you are unable to make it for the presentation itself, you'll still get that replay at a later time. So without further ado, thank you guys for joining us. We know taking time out of your day is important to get some good information, so hopefully we are able to present that today as we look at these indexed annuities from Origins to Alts. Now, if you do have any other questions, you can always call our sales desk at 888-ANNUITY. That's 888-266-8489, 888-266-8489. We'd love the opportunity to speak with you about this information in more detail. So without further ado, we'll get started here today. Fixed indexed annuities. Fixed indexed annuities offer a unique combination of protection and growth potential. In this presentation, we're going to unpack some of the fundamental principles of the index and indexed annuities and explore the dynamics from both a product and a market perspective. First, we'll visit or perhaps revisit some of the basics of annuity design. Whether you're new in the index sector or a seasoned veteran in the space, this review will help frame a deeper discussion of some of the more nuanced aspects of index dynamics. Then we'll take a look at some of the basic components of indices. And this will set the stage for a deeper discussion into the evolution of the space, primarily the rapid rise of the use of what are collectively referred to as alternative or alt indices. Starting with the basics, remember that the annuity space itself can be categorized a number of different ways. The textbook definition of annuity often describes income annuities, which actually represent only about 4% of all annuities sold. With these products, the owner or annuitant pays a premium to the issuing company in exchange for a series of future payments for either a specified time period or for the lifetime of the annuitant. A majority of income annuities sold today are immediate annuities, where the payout must begin at or shortly after issue. Deferred income annuities allow the payout to be delayed for a period of time. Over 9 in 10 annuities sold today are deferred products that allow for accumulation of principal. About 20% of these products are traditional fixed annuities, where the deferral period includes a guaranteed rate of interest for a specified period of time. About 30% of deferred product sales are fixed indexed annuities. These are products we'll be focusing on today. They were first developed in the mid-90s and are currently enjoying robust sales growth. Indexed annuities can be differentiated from traditional fixed annuities by the method in which interest is created to the owner's policy. Instead of coming in the form of a declared rate, the interest credit instead reflects participation in the growth of an underlying index. All the products we've covered up to now, denoted in various shades of blue on the slide, can collectively be considered fixed annuities, meaning that the basic returns come in the form of an interest credit. The rest of the fixed annuity marketplace consists of variable annuities shown in red on the chart. In the case of variable annuities, the returns are generated via participation in underlying sub-accounts similar to mutual funds. The key consideration is to understand that variable annuities introduce the notion of potential market loss, which occurs if the underlying sub-accounts experience low or negative returns. For this and other reasons, variable annuities are considered securities and may only be sold by securities licensed agents. Fixed annuities, on the other hand, require only the insurance license. Now we'll begin to focus more on index annuity dynamics. Here's a high-level look at the index annuity construct. The bullseye is the product's core guarantee, which is protection of principal. Next, most index annuities offer the opportunity to go into a fixed rate option, similar to a traditional fixed annuity. But more importantly, the index annuity includes interest crediting strategies that offer additional growth potential via participation in the performance of an underlying market index. With index crediting strategies, the possibility of a 0% return exists if the index doesn't perform, but there's no further exposure to loss, even if the index declines significantly. In addition, participation in the upward movement of an index over time provides the opportunity for interest credits that may be higher than those guaranteed by traditional fixed annuities. Remember the principal protection bullseye in the last slide. Here's another way to look at it, to see the guarantee at work in an indexed annuity. Think of an index as a measuring stick, measuring the performance of a market. Measuring stick number 1 represents the potential returns of an underlying index in an index interest crediting strategy. Regardless of which index we are talking about in any given measuring period, the change in the index from beginning of the period to the end can be positive or it can be negative. This brings us to measuring stick number 2, which represents the insurer's guarantee to protect the owner's account value against loss should the underlying index decline. Hence the industry term, zero's your hero. Finally, stick number 3 shows how the insurer, quote unquote, pays for that guarantee. The dark blue portion of the arrow represents the annuity owner's participation. The difference between the index return and the owner's participation essentially is the cost of insuring the owner against loss of principal if the market is negative. Broadly speaking, the insurer has established hedges using options, futures, or other tools to back the guarantee. The insurer's hedge budget is typically fixed at the time of issue. So after the hedges are put in place, the insurer can calculate an appropriate initial participation rate. Because the hedge budget is generally fixed over the life of the policy, the budget may buy higher or lower participation rates in subsequent renewal periods, depending on the then current prices in the hedging market. Here are some notes on participation. In this presentation, I'm using the term participation to represent the general concept of how an interest credit is determined. In fact, to be more technically precise, a number of participation strategies exist. Let's take a look at 3 common strategies and see how they compare when applied to an index earning 4%, 8%, and 12% over a given period of time. A cap imposes an upper limit on the amount of interest credited, regardless of index performance. It is possible to earn less than the cap, but not more. A spread deducts a portion of the index return. With a 2% spread, for example, the index return must be greater than 2% to receive any interest credit. But the higher the index return, the higher the interest earned. And thirdly, a participation rate means the interest credit is based on a percentage of any increase in the index. Now let's drill down into the concept of index. In broad financial terms, an index is a tool that allows us to measure the change in a securities market. There are indices for almost every economic sector and stock market, and new ones are being created all the time. A few of the most popular indices are on the right. As for fixed index annuities are concerned, keep in mind the notion of an index as a measuring stick. We use the actual performance of a specific index as one factor in establishing the ultimate interest credit. So which index is best? This slide shows the performance of a variety of indices, all of which are used in Athene products back to 2006. In fact, the dark blue line that dipped sharply in 2008 tracks the performance of the S&P 500, perhaps the most widely known index. The other 3 indices represent the performance of a series of volatility control indices. We'll discuss vol control later and come back to this slide in more detail. For now, just note how over the long term, all of these indices have generated decent returns, but they all follow different paths to get there. Also note that in any given year, it is impossible to predict how an index will perform in the coming year. So let's go back to that S&P 500. It's probably safe to say that this is the index that is most widely known, and most investment and insurance professionals are at least somewhat familiar with its composition. The The S&P 500 is also used in a wide range of investment-related products and strategies, and at least partially because of this, a mature liquid S&P hedging market exists. So it's no surprise that S&P-based strategies dominated the index annuity market in its early stages. Even today, S&P-based strategies represent about half the dollars that flow into index annuity strategies. But if S&P-based strategies have dropped from virtually 100% in the mid-90s to around 50% today, where's the rest going? This chart shows the dramatic growth of a new category we'll call alternative or alt indices over the past 9 years. Starting with a virtual 0% share in only 9 years ago, alt indices now account for 35% of the total market today. When you consider that the index annuity market itself has more than doubled in that same time frame, the growth of alt indices is even more impressive. So what are alt indices? The alt index space is diverse, but there are some common elements that distinguish them from traditional index designs like the S&P 500. As this table shows, alts typically reflect a specialized group of components or even a blend of several underlying independent indices. They typically employ some rule-based algorithm that rebalances, reweights, or realigns the underlying components, typically at a pace that's much more dynamic than traditional indices. And they also typically include a volatility control mechanism. So here's an example of how those alt criteria work in the indices Athene offers on our products. Notice the index composition and the rule-based design and frequency of the rebalancing mechanism. Also notice the use of a mechanism to manage volatility. So now with a better understanding of how the alt indices work, let's explore some of the reasons why they have become popular. As this slide indicates, alt indices enable differentiation and diversification relative to the S&P 500. Because the underlying components are different, an alt index may zig when the S&P zags. In addition, the underlying algorithm may attempt to generate higher returns than the S&P 500 or other indices. When you also factor in the volatility control aspects, alt indices may generate less volatile or more predictable returns than the broad market. This volatility control can be a key component in minimizing hedging costs. In general, it's cheaper to hedge an instrument whose underlying returns are less volatile. And hedging efficiencies, that typically translates into higher participation rate and thus higher customer value. Clearly, volatility control is an important consideration on an index design, so let's dig a little deeper on that. This slide depicts a common and representative view of volatility control mechanisms. Starting with a base or underlying index, a typical volatility control mechanism tracks the underlying volatility in the market. When high or increasing volatility is evident, the mechanism triggers an automatic response which reduces exposure to the underlying index and moves a portion of the exposure to cash. This cash cushion can smooth the returns when markets are volatile. Over time, the strategy essentially aims to win by minimizing the degree of loss experienced when the index would otherwise fall sharply. It should be noted that the strategy may also cause a volatility control index to earn less over time than the underlying index, but we'll see in a moment why this may be a good thing. While an underlying index may rise or fall sharply, its vol-controlled version will likely rise less and fall less. In the case of an indexed annuity, if the insurer already guarantees against loss, why would it be in the owner's interest to accept less potential? Remember our earlier example? The interest credit that the owner receives is based not only on the return of the index, but also on the strategy participation rate. Since the insurer can hedge volatility control indices more efficiently than the underlying or unconstrained index, the net participation may be higher. And this helps explain why so many insurers have been and are continuing to introduce new alternative volatility control strategies. We are constantly seeking indices whose constructions and algorithms can yield stronger returns and applying vol control strategies when we believe the net result can offer a reasonable opportunity to pass through higher value to your clients. The following slide gives an overview of the alternative indices offered with Athene. And with that in mind, let's pause for a moment to examine some of the considerations that we employ when considering adding a new index to our product mix. Here are 3 key factors that Athene is going to look at. Does the index construction include the components, algorithms, and volatility control represent a valid, sustainable premise? Does the index represent a new or differentiated strategy relative to our existing inventory? And can we efficiently hedge the index in a manner that enables us to pass high customer value through to the owner? So let's look at 2 perspectives, the carrier and the customer. Lower hedging costs on the carrier side translate into the chance for a higher participation rate and stable renewals for the customer. More indices in the marketplace allow carriers to differentiate and give customers more strategy choices. And greater potential upside also gives fixed index annuities a stronger position in the market at large. Now let's take a look at this chart that we used earlier. First, let's focus on the dark blue patch, the S&P 500. The chart vividly depicts the market disruption that occurred in 2008. Of course, if you measure performance after 2008, the unconstrained S&P has done quite well. But compare it to the orange line, which represents an all-equity vol control index. Notice that the vol control mechanism allowed this index to ride through 2008 without much disruption. Taking a long view, both these indices report similar long-term results, but the vol control version followed a much smoother path for the client. The previous slide was a telescopic view, taking a long-term view of markets and volatility. Now let's look through a microscope at a very brief, very recent volatility event. The time period depicts a 1-week period, of how various indices responded to the Brexit vote. When Great Britain unexpectedly voted to withdraw from the European Union, many markets immediately fell sharply before rebounding. Starting with the dark blue line representing the S&P 500, we see once again that the unconstrained market fell the most before bouncing sharply back. At the top of the chart, the red line, which represents our new BNP MAD 5 index, the index not only employs a 5% vol control mechanism, but it also employs a completely different algorithm and underlying components, which include not only U.S. stocks, like the S&P, but other components, such as foreign stocks and bonds and some commodities. So this index is not highly correlated to the S&P 500, and using the terms I used before, it was able to zig when the S&P was zagging. And that's a real up-close look at short-term vol control dynamics. Now let's look at some of the practical considerations that we've covered today. Illustrations are a common tool employed in the sales and due diligence process, and there is an increasing regulatory concern over how they are used. Many alt indices have short actual histories, but are based on underlying components with longer track records. So it's possible to construct an algorithm and apply it to a series of existing components to come up with an alt index that would appear to have done very well over some past period. The problem is, the index didn't actually exist, and the entire construct, components plus algorithm, may have been built to optimize performance in a scenario that occurred over the past 10 years. In fact, the construct may perform very differently in the future because we don't know what will emerge in the years ahead. For example, over the past 10 years, interest rates have fallen dramatically. When interest rates are falling, bonds tend to perform very well. So it's no surprise that many alt indices that boast superior performance characteristics employ algorithms that were designed, with hindsight, to ensure that they will have significant allocations to bonds during periods of falling interest rates. How such indices might perform if and when interest rates rise may be another story altogether. Here's another item to consider in the use of illustrations. This slide shows a comparison between 2 potential choices of lifetime income. Which would you choose? Most people would pick 1. But in fact, 1 and 2 are actually the same index, just reflecting 2 different time periods. These help explain some of the reasons regulators take a strong interest in illustrations. It's worth considering as you find yourself in a competitive situation. So in summary, index annuities offer an opportunity to earn better returns. A wide array of new interest crediting strategies have emerged, often utilizing alternative indices and volatility control mechanisms. So what do you suppose NCV equals R times P represents? Net customer value equals index return times customers' participation. So I hope that the information, again, was something that you guys can find useful, whether you're new to the industry or you've been here for a while. It's just a way to recap why so many carriers are looking at these alternative indices. And to further go into some of the alternative indices, again, we are hosting a webinar this afternoon at 2 p.m. Central Time that will be going over our new Apex index. There is still time to register for that. Go to Athene.com in the lower left-hand corner. You'll see the webinars out there. If you have any questions, please feel free to reach out to our sales team at 888-ANNUITY. That's 888-266-8489, 888-266-8489. We'd love the opportunity to go over this information and discuss our alternative indices and how those have been helping our clients in all of our products available. Again, we appreciate your time and look forward to working with you very soon. Thank you and have a great afternoon.